Welcome, everyone. Thank you for joining us. Today is Thursday, July 9th, and today's webinar is Long-Term Care Hybrids versus Traditional Long-Term Care Insurance, presented by Scott A. Olson, CLTC, co-founder of LTCshop.com. Today, Scott will show you an easy way to compare long-term care hybrids and traditional long-term care insurance policies and help you determine which type is best for you. Today's webinar will last about 45 minutes, followed by a 10 to 15 minute question and answer session. All attendees will be in listen-only mode throughout the webinar. During the webinar, please email your questions directly to scott@ltcshop.com. After the presentation, Scott will answer as many questions as time allows, and any questions not answered during the webinar will be answered personally by Scott via email within 2 business days. Scott is the author of Simple LTC Solution: How to Protect Your Life Savings with a Long-Term Care Partnership Program. It is available on Amazon.com. With over 25 years of experience specializing in long-term care insurance, Scott is a sought-after expert on the 5 types of insurance policies that can help pay for long-term care: traditional long-term care insurance, long-term care partnership policies, hybrid life insurance policies, hybrid annuities, and recovery care policies. Over the years, he's been quoted in numerous leading publications, and he is licensed to sell long-term care insurance in all 50 states, including the District of Columbia. Without further delay, I'll turn this webinar over to Scott.
Thank you, Carolyn, for your kind introduction, and thank you to everyone attending today's webinar. I'm Scott Olson, and it's my honor and my privilege to be able to spend this time with you and to share this information with you. Before we dive right into each topic, let me give you a quick overview of what we're going to cover today. First off, we're going to talk about what is an LTC hybrid. There are 2 main types of LTC hybrid, and we're going to look at both of those. Secondly, we're going to talk about an easy way to compare policies. Shopping for long-term care coverage is usually not easy, but I'm going to share with you a very simple technique that will make it a lot easier, okay? Third thing, we're going to talk about the different parts of an LTC hybrid. Every LTC hybrid has 4 parts, and we're going to take a look at all 4 parts. And once you understand those 4 parts, it'll make it a lot easier for you to understand how the policies work and to understand which policy is better than another, which policy is a better value than another. Fourth, we're going to do a case study. We're going to look at a 59-year-old couple that buys a single premium hybrid. We're going to look at another 59-year-old couple who buys a traditional long-term care insurance policy, and we're going to talk about the differences. Fifth, we're going to talk about rate increases for rate increases that are on traditional long-term care insurance policies. And we're going to talk about some of the rate increase protections that are in effect for people who buy long-term care insurance today. And lastly, we're going to talk about who should buy LTC hybrids. There are situations where LTC hybrids are much better value than a traditional long-term care insurance policy. So we're going to look at those situations, and that you might be, one of those situations might be your situation. And last thing we're going to do is our question and answer time. We always want to be able to answer your specific questions, so get your questions ready. At the end of the webinar, we'll spend about 10 to 15 minutes answering your specific questions. Okay, thanks. Let's get started. Okay, so what is an LTC hybrid? Well, a hybrid is anything made by combining 2 different elements, okay? And in our society today, the most obvious example of a hybrid are the hybrid vehicles. And they're called hybrid because they combine 2 different types of power sources. The gasoline engine combined with the battery engine or the battery pack. And both of those energy sources are used to propel the vehicle. So that's the most common example of a hybrid today. Now, LTC hybrids combine two different types of insurance products. So the most common example is a life insurance policy that combines some type of long-term care insurance. And we call that a life LTC hybrid. And this is the most common example of hybrids in the insurance industry today. Life insurance combined with some type of long-term care insurance. And these products are not new. They've actually been around since the late 1980s, early 1990s. They were first created by a company called Golden Rule Insurance Company in Indianapolis, Indiana. And a lot of other companies have caught on and have started to offer the exact same products or similar products using the similar combination of life insurance plus long-term care insurance. Now, there's another version which is based with an annuity. So you have an annuity, and then you add some type of a long-term care insurance feature to the annuity as well. And of course, we call those annuity LTC hybrids. Okay, so let's look at the easy way to compare policies. A simple technique that you can use to easily compare any type of long-term care coverage. So let's take a look first at the most important feature. No matter what type of long-term care coverage you're looking at, whether it's a traditional long-term care insurance policy, whether it's a long-term care hybrid, doesn't make any difference. No matter what type of long-term care coverage you're looking at, the most important thing is to compare apples to apples with the monthly benefit. Okay? Comparing a LTC hybrid that's going to pay $1,000 per month for care is not the same thing as comparing a traditional policy that's going to pay $5,000 per month for care. So it's very important that when you compare apples to apples, when you're comparing policies, that you come as close as possible to an apples to apples comparison with the monthly benefit. And in this example, I'm just going to say the monthly benefit is $4,800. That's what I want to compare. Now, the second thing you need to compare is the lifetime benefit. And that means what's the most the policy can pay in benefits over your lifetime. And again, if you're looking at a life LTC hybrid that can pay $100,000 worth of lifetime benefits, that's not going to be comparing apples to apples to a traditional policy that's paying $500,000 of lifetime benefits. So again, it's very important to try to come as close as possible to an apples to apples comparison with the monthly benefit and the lifetime benefit. Okay, so focus on those two features. And of course, the premium is vitally important as well. How much is it going to cost? Now, but keep in mind, we buy these policies not because we're going to need to use them a year from now. You might not need to make a claim on your long-term care coverage for another 5 years or 10 years or 20 years, okay, or 25 years. So it's important to know what are these values going to be in the future, okay? How much is that monthly benefit going to be 24 years from now? How much is that lifetime benefit going to be 24 years from now? And I chose 24 years for a reason, but I'll show you that in a second. But with most policies, especially with most hybrid policies, most LTC hybrids, there is no inflation growth. There is no growth in the benefits. And that's really a shame, okay? 9 times out of 10, anybody buying any type of long-term care coverage should include some type of growth in the benefits every year. It's called inflation protection. And you should include the inflation protection. In most cases, it makes sense to include some type of inflation protection. So if, for example, we had a 3% compound inflation protection included in this policy, then after 24 years, we'd have a monthly benefit of $9,600 because the $4,800 would grow every year by 3%. and within 24 years, it would double. And same thing with the lifetime benefits. With most long-term care coverage, the inflation protection grows the lifetime benefits as well. So these are the values you need to focus on when comparing different policies. How much is it going to pay per month if I need care this year? How much is it going to pay per month if I need care 24 years from now? What's the most it can pay in benefits if I need over my lifetime now? And does that grow over time? So these are the values you need to focus on. And if you do that, it'll make it a lot easier for you to see which policy is best for you. Okay. Okay, so let's take a look at the 4 parts of every LTC hybrid. Every LTC hybrid has these 4 parts, no matter which one you're looking at, and there's lots of different ones. There's lots of variations of LTC hybrids. So they all have 4 parts, okay? So let's take a look at those. The first part is the single premium. Now, most, or at least certainly the most popular hybrids are funded with a single premium, just one large single premium payment that you make. There are no ongoing premium payments. You just make one single lump sum premium payment. All right. And, it's how much you put into it is very flexible. Okay. You are actually in charge. You're the one who decides how much you want to put into the hybrid. Okay. So typically you can put in anywhere from 50,000 to as much as 300,000, or some policies even more than that. So you decide how much you want to put into the hybrid, and of course, the more you put in, the richer the benefits. Now, and that's why it's called asset-based long-term care. Okay, it's called often called asset-based long-term care because you're moving an asset. You're taking an asset, maybe from one of your assets, maybe a CD or money in a savings account or cash value life insurance that you don't need anymore. So you want to, that cash value is an asset, and you take that and put it into the hybrid. All kinds of options, all right? But that's why it's called asset-based long-term care. Now, the second part of every hybrid is the cash surrender value. That means, what will you get back if you cancel it? What will you get back if you surrender the policy? And with the most popular hybrids, you're usually looking at a cash surrender value that's equal to the single premium. Okay, it's usually about the same. Okay, now the third feature, the third part of every hybrid is the death benefit. So the cash surrender value is how much you'll get if you cancel the policy or you surrender the policy. The death benefit is how much your beneficiary will get if you die without needing to use the long-term care benefits. So if you don't need long-term care, the death benefit is what your beneficiary gets. And that's really the appeal. That's what's most attractive about these policies, is that, well, if I don't need long-term care, at least there's going to be some value derived from the policy. So yeah, and that's the death benefit. Now, if you do need long-term care, the death benefit is used to pay for your long-term care. Okay, so with most policies, about 1/25 of the death benefit is used to pay for your care each month. So whatever your death benefit is, 1/25 of that approximately, and every policy is a little different, but this is pretty typical. So 1/25 of your death benefit is used to pay for your care each month. And so gradually the death benefit goes down until there's just with some policies, there's a small residual death benefit. Some policies wipe out the entire death benefit. Some will still give you a small residual benefit. And now the better hybrids will continue to pay the long-term care after you've depleted the benefit. Okay. Oh, I forgot to mention, the cash surrender value is wiped out once you've depleted the death benefit. Okay, so when you deplete the death benefit, there's no longer any cash surrender value. You can't get any cash from the policy after you've depleted the death benefit. But after you've depleted the death benefit, if you still need long-term care, the better hybrids continue to pay the long-term care through what's called an extension of benefits. Oops, okay. Here it is, extension of benefits. Now, and the extension of benefits can add maybe another 4 years of benefits onto the policy. That's pretty typical, okay? Now, let's just review these 4 parts, okay, so we can get a better understanding of them just looking at them simply side by side. The first part is the single premium. Second part is the cash surrender value, what you'll get back if you cancel the policy, what you'll get back if you surrender the policy. And with most policies, the cash surrender value equals the single premium. Third part is the death benefit. What will your beneficiary get if you don't need long-term care? All right. And the death benefit is usually a little bit more than the single premium. And then there's the long-term care extension of benefits. And that is, how much will the policy pay in long-term care benefits, or what can it pay? What can it potentially pay in long-term care benefits? And the long-term care benefits are usually twice what the death benefit is. Okay. So you can see why these policies are popular. You pay one simple single premium. There's no ongoing premium payments. You just pay one lump sum single premium. If you want to cancel it, or you want your money back for any reason, you can surrender it and get your money back. If you die without needing care, then your beneficiaries will get the death benefit, and that's usually a little bit more than the single premium. And of course, if you need long-term care, it'll pay long-term care. So you can see why these are very popular. There's only one thing wrong with this chart, and that's the conjunctions. Okay, the conjunctions. You don't get cash surrender value and a death benefit and long-term care. You're going to get cash surrender value or a death benefit or long-term care. You don't get all 3. You're just going to get one. If you, for example, if you take the cash surrender value, well, that means you forfeit the death benefit and you forfeit the long-term care benefits. If you die without needing care, well, yes, your beneficiary will get the death benefit, but they're not going to get the cash surrender value, and there's no long-term care benefits either, right? And if you do need long-term care for at least 25 months, well, then there's going to be little or no death benefit left, maybe a residual death benefit, but probably not. Okay, if you need long-term care for 25 months or more, it's going to wipe out the death benefit. And of course, there's no cash surrender value either. So you're not going to get all 3, you're just going to get one of these 3. Okay, so let's take a look at a case study comparing a long-term care hybrid versus a traditional long-term care insurance policy. And in this case, we're going to look at 2 couples, Lucy and Ricky, both age 59, and Jim and Pam, both age 59. And I chose 59 because that's about when most people buy some type of long-term care coverage. That's about the average. So of course, many people buy it earlier than that. Many people buy it later than that, but that's about the average. So let's look at what Lucy and Ricky buy. Their hybrid would start off with a monthly long-term care benefit of $4,800 per spouse, and LTC benefits, lifetime long-term care benefits, of $350,000 per spouse. Now they include the 3% compound in their hybrid. This is one of the better hybrids. A lot of hybrids don't have inflation protection, or a lot of agents or advisors just don't quote the inflation protection, but inflation protection is important. Okay, so they include the 3% compound inflation protection. And so by age 83, they're going to have a monthly benefit of $9,600 per spouse and long-term care benefits of $700,000 per spouse. Now, when we look at that, their annual premium is, let me pull it up, $200,000. I'm sorry, their single premium is $200,000. That's $105,000 for Lucy's policy and $95,000 for Ricky's policy. So combined, they're putting $200,000 into their two hybrids. And that's not so bad. I mean, they're putting that much money in, and by age 83, they've got $700,000 each. That's $1.4 million total between the two of them, and that's that's about 7 times what they put into the policy. So that's not a bad value. Now let's look at what Jim and Pam do. Okay, Jim and Pam buy a traditional long-term care insurance policy. Now they also start off with a monthly benefit of $4,800. Okay, and they also include the 3% compound in their monthly benefit. So by age 83, that monthly benefit will have doubled. They'll have $9,600 per month per spouse. And so we take a look at it. You can see it's identical monthly benefit for each. And comparing these policies, we're making the monthly benefits identical. Okay, and so you need to have some type of peg when you're comparing policies. You need something that's going to be the same from one policy to the next, so that you can know you're comparing accurately. So now traditional policies are a little bit more flexible in terms of how the benefits can be set up. So Jim and Pam get shared benefits. They're going to buy, with this policy, they have $875,000 worth of long-term care benefits, of shared long-term care benefits. And this policy allows one spouse to use as much as 2/3 of the long-term care benefits. So there's always 1/3 reserved for the other spouse. So one spouse can use as many as 2/3 of as much as 2/3 of the benefits. And because of the inflation protection, that $875,000 grows to $1.75 million by the time they're age 83. And they can purchase that policy for $4,300 per year. That's their combined annual premium. And that premium includes the inflation growth. There are no planned premium increases in that policy. That $4,300 includes the 3% compounding. So even though the benefits are growing every year, that growth in the benefits each year does not make the premium go up. And now you might be saying, well, Scott, that's crazy. I've never heard of a long-term care policy that could grow to $1.75 million worth of long-term care benefits. Well, that's why you're listening to this webinar. Okay, that's why you're watching this. Because unfortunately, most people in this industry, most insurance agents, most investment advisors tell people that they should buy 2 years of benefits or 3 years of benefits. You know what? Most of my clients are not concerned about needing 2 years of care or 3 years of care. They're concerned about a catastrophic need. And if you do the math, Jim and Pam are buying 15 years of shared benefits, okay? And one of them can use as much as 10 years of benefits. So this is, this policy is going to protect them against a catastrophic event. Clearly, both of these strategies are very different, okay? So what we're going to do now is we're going to look at 3 possible scenarios, 3 different scenarios of what could happen in the future, and which of these strategies is the best strategy for each scenario, okay? So first off, let's just look at Lucy and Ricky. And again, Lucy and Ricky bought 2 single premium hybrids for a total premium of $200,000. Lucy's hybrid cost $105,000. Ricky's hybrid cost $95,000. So combined, they put $200,000 into their single premium hybrids. Now, Jim and Pam had a little different strategy. They said, well, let's put the $200,000 into a special investment account. Now, I don't know how they're going to invest it. I'm not an investment advisor, but they feel confident that they can invest it and earn some good money safely. So they put the $200,000 into their, what they call their special investment account. And they're going to earn money on that $200,000 every year. And the earnings, they're going to take that earnings and they're going to pay their long-term care premium every year. Okay, so we've got $4,300 annual premium for them. they're going to be earning. So all they need to do is earn a little bit more than 2% on this special investment account every year, and that'll be enough to pay the annual premium for their traditional long-term care insurance policy. Now, how much are Lucy and Ricky earning on their $200,000 that they put into the hybrids? 0%. Lucy and Ricky are not earning anything on that $200,000. They're earning 0%. Now, you might say, Scott, that's not true. The illustration I have in front of me shows that this hybrid guarantees a 4% interest rate every year. Well, that's true, that the internal values of that policy are going to grow by 4% every year. That's guaranteed before the expenses. It doesn't mean that you're going to get $200,000 plus 4% every year. If you surrender the policy, you're just going to get the $200,000. So if Lucy and Ricky say, let's just surrender the policy, they're just going to get back what they put in. In other words, they're earning 0% on the money. Now, yes, Jim and Pam, they're going to earn their $4,300 per year, or they're going to earn whatever they earn on the investment account. They're going to pay their annual premium every year. And yes, that premium, that $4,300 they pay every year, that annual premium, if they never need long-term care, that annual premium is wasted. Here's my giant wastebasket. They're wasting that money every year. Well, Lucy and Ricky are wasting every year what they could be earning on their $200,000 single premium. They're wasting what they could be earning because they're earning 0 on that money. So let's take a look at the first scenario. Scenario number 1, where they need long-term care. So let's suppose that Lucy and Ricky need long-term care. And let's suppose that Jim and Pam need long-term care. Which couple is going to be better off under these under this scenario, under this scenario number 1? Well, if Lucy and Ricky need long-term care, yes, they're going to get long-term care benefits from their hybrids. That's why they bought them, right? But if they need care for at least 2 years, well, that's going to wipe out the death benefit. If the death benefit's wiped out, well, then there's no cash value either. And they're not getting the single premium back because they've wiped out the cash value. So if Lucy and Ricky need long-term care, yes, they're going to get the long-term care benefits. And they're going to get back at least what they put in if they need care for at least 2 years. And in this scenario, I mean, both Lucy and Ricky, they each bought 6 years of benefits. So Lucy would run out of benefits after 6 years, and Ricky, if he would have 6 years of long-term care benefits too. Now, what about Jim and Pam? Well, they bought much richer long-term care benefits. Okay, they actually bought 15 years of shared benefits, and one spouse can use as many as 10 years of benefits. Okay, so they're really protected against a catastrophic event. Now, if they need long-term care, guess what happens? Their annual premium stops. They don't have to pay their annual premium anymore. And that annual premium is just going to be, or those earnings that they're going to make on that special investment account can just be reinvested every year. And that special investment account can just grow and grow and grow. So in this scenario, Jim and Pam are much better off than Lucy and Ricky. Yes, Lucy and Ricky got some long-term care benefits up to 6 years each, okay? But the original $200,000 they put in, that's gone. They're not going to get that too. Jim and Pam, they've got up to 10 years of long-term care benefits, up to 15 years for the two of them. And the $200,000 that they put in that special investment account, they get to keep that. So in this scenario, Jim and Pam are much better off than Lucy and Ricky. Jim and Pam have much richer long-term care benefits, and they've got the original 200 grand. Now, let's look at scenario number 2. Use the cash. What if Lucy and Ricky decide they want to go on a world cruise? So they say, well, let's use the 200 grand that's in the cash value, or that's in their hybrids. No problem, they can do that. They pull out the cash value. But when they do that, they forfeit the policy. They surrender the policy. They lose the death benefit. They lose the long-term care benefits. They get the cash, and that's it. They no longer have any death benefit. They no longer have any long-term care coverage. Now, if Jim and Pam decide they want to do the same thing, they want to go on a world cruise, well, they can just empty out that special investment account and go on that world cruise. All right. And their long-term care policy, they take out the cash. Their long-term care policy still remains in force. They still have their long-term care coverage as long as they pay the annual premium each year from their other income sources. So they don't have to sacrifice their long-term care coverage in order to access their cash. Now, what about scenario number 3? What if you just die? Okay, you don't need long-term care, you just die. What if Lucy and Ricky just die? All right, what happens then? Well, if they just die, their heirs don't get the single premium. Their heirs don't get the cash value. Okay, nobody gets any long-term care benefits because they just die. Okay, so if Lucy and Ricky just die, then their heirs get the death benefit, which in this case was $115,000 for Lucy and $115,000 for Ricky. So they paid $200,000 in single premiums, and their heirs get $230,000 of death benefit. So at least they got back a little bit more than what they put in. What about Jim and Pam? They've got a traditional long-term care policy. Okay, there's no death benefit with their long-term care policy. Well, that's true, but they don't need a death benefit. Okay, if they die, yes, they don't get any long-term care benefits, but their cash, they've had $200,000 sitting in that investment account, and it's probably even grown every year. So that can go to their heirs at the time of death. Instead of having forfeited that $200,000 or using it to pay the single premium hybrid, they had kept that 200 grand and invested it, and it grew. Okay, probably grew. Okay, even though they're paying their long-term care premium every year. So their heirs can get that at the time of death. So yes, in this scenario, Lucy and Ricky's heirs are slightly better off than Jim and Pam's heirs. Okay, but not much better off. And clearly, in scenario number 1 and scenario number 2, Jim and Pam were much better off than Lucy and Ricky. Okay, so clearly, based upon the case study, we can see that traditional long-term care insurance can be a very good value, especially for healthy married couples. But Scott, what about the rate increases? Aren't these premiums just going to go through the roof? Well, let's talk about that. First of all, we've got an entire webinar just devoted to rate increase regulations, and how newer policies are protected from the old rate increases. So go to my website, click on webinars, and you can sign up for the next one that's coming. But first of all, there's one thing you need to watch out for, and that's there are policies that have built-in rate increases. Okay, policies that have built-in rate increases. For example, you could buy a policy that has, let's say, for example, it starts off in year 1 with a $2,400 annual premium, and that policy would increase, the premium and the benefits would increase every year by 5%. So by year 30, the premium's quadrupled. By year 30, you've got a $9,600 annual premium. It's gone up, it's quadrupled over that 30-year period. And I hear from people who bought policies like this 20 years ago or 25 years ago, and they're experiencing these annual premium increases. And I've got one word of advice for somebody considering buying long-term care insurance today, and that's this: don't buy a policy like this. You don't have to buy a policy like this. Don't buy it. Okay. 99 times out of 100, it does not make sense to buy a policy that has built-in rate increases. So, understand what you're buying. And it just, again, it typically does not make sense to buy a policy like this. There are lots of policies that have growth in their benefits every year, but no planned premium increases. So you don't need to buy a policy like this where the premium is going to be doubling, tripling, quadrupling over your lifetime. All right, well, what caused the rate increases on these older policies? What was the cause? Well, go to ltcshop.com, click on rate increases. We've got a 2 or maybe 3-minute video called Why Rate Increases Happened. And you'll be shocked, okay? We share the number one reason, the single biggest cause for rate increases. And it's not what you think. It's not what you read on Forbes, okay, or on Consumer U.S. News and World Report or Consumer Reports. It's completely different, but we don't have time to explain it right now. But after the webinar, go there, watch that video. Take you about 3 minutes. Now, here's 5 quick facts about rate increases. First off, premiums can't be raised because you reach a certain age. I don't know how many people have said to me, Scott, I turned 70 and I got a rate increase. Okay, I got a 30% rate increase when I turned 70. I got a 50% rate increase when I turned 75. No. You did not get those rate increases because you reached a certain age. Long-term care insurers cannot raise your rates because you reach a certain age. That's illegal. It's against the law. It violates your state's insurance regulations. They can't do that, okay? If you got a rate increase when you turned 65, okay, or if somebody you knew got a rate increase when they turned 65 or 70 or whatever, they got that rate increase. Everybody in that state, everybody in their state with the same policy got the same rate increase or a very similar rate increase, all right? And it had nothing to do with their age, whether they were 70, 75, 60, 50, doesn't matter what their age was, the same rate increase was shared by everybody who bought that same policy. So the insurance companies cannot raise your rates just because you reach a certain age. Secondly, you can't be singled out for a rate increase. They can't just raise your rates. If they're going to have a rate increase, it has to be shared amongst everybody in your state who has the same policy. Thirdly, any premium increase has to be based upon claims. It has to be based on their current claims and their most accurate projection of their future claims using the most current claims data. So they can't just decide to raise rates because they want to. Okay, they just can't decide to raise the rates just because they feel like it. They've got to submit the rate increase request to the Department of Insurance, and it's got to have an actuarial justification. It's got to be justified based upon claims, not something else. Okay, they just can't decide they want to raise rates because they feel like it. Okay. Fourth, any premium rate increase, we mentioned this already, must be shared by everyone in your state who has the same policy form. They can't single you out. And number 5, premiums can't be raised just to increase insurance companies' profits. And you'd be surprised how many people think that this is true, but think that the insurance company can just raise rates because they want more profit. No, they can't do that. Rate increase regulations, insurance regulations in all 50 states do not allow them just to raise rates in order to increase profits. That's not allowed. You're protected. There are regulations, there are insurance regulations set up to protect you. Okay. So new policies versus old policies, just briefly, in all 50 states, any new policy can't be sold if it uses the old claims projections. Here's the bottom line. The insurance companies, when they priced the policies 20, 25 years ago, they had no idea what they were doing. They had no idea. Their claims data, their actuarial assumptions were terrible. That's why those older policies have had huge premium increases. All right. New policies can't be priced on those old same mistakes. Okay. They can't use the old faulty claims projections to price new policies. New policies have to be priced using current data, using the most accurate data available today. And old rate increases have to be priced into the new policies. So you're not going to, if you buy a new policy today, or people who are buying policies today are protected from the old rate increases because the new policies already include all the old rate increases. All the old rate increases are already priced into the new policies. So you're not going to be getting those old rate increases because when you buy a policy today, you already have that policy you're buying today already has all the old rate increases. And that's what I mean by bad news versus good news. The bad news is that long-term care insurance policies purchased today are the most expensive policies ever sold in your state. That's the bad news. Here's the good news. Long-term care insurance policies purchased today are the most expensive policies ever sold in your state. Yes, that's right. I repeat myself. The bad news is the good news. The bad news is the good news. The new policies are the most expensive policies ever sold today. Okay? They are the most expensive policies ever sold because they're priced for stability. They include all the old rate increases in today's policies, and they're priced to remain stable. Now, so also when you go to ltcshop.com and click on rate increases, click on where it says the truth about long-term care insurance rate increases. That's a video where we explain how newer policies are protected from the old pricing mistakes. Okay. Now, lastly, won't rates rise as the cost of care rises? The care is going to, long-term care expenses, home health aides are going to cost more 20 years from now than they do now. Well, doesn't that mean, Scott, that the insurance companies are going to have to raise their premiums because home health aides are going to be charging a lot more 20 years from now than they charge now? No, that won't cause rates to go up. Okay. Long-term care insurance is not like medical insurance. Okay. Your medical insurance premiums go up every year because the insurance companies can't predict how much the cost will be. And they know they're going to have to pay 80% of whatever the cost is. So, and they can't predict what the overall cost will be. And that's why every year medical insurance premiums go up. All right. Long-term care insurance is completely different. With long-term care insurance, they can predict what they'll have to pay. Now, the long-term care insurers can't predict what a home health aide will be charging 20 years from now, but they can predict how much their policies will have to pay because every policy has a daily cap. And that daily cap grows every year by the inflation protection that you choose. So they know exactly how much they're going to have to pay for every day you need care, if it's 10 years from now, 15 years from now, 20 years from now, because they're not going to have to pay any more than that daily cap, regardless of what the actual cost of care is. So won't rates rise as the cost of care rises? No, they won't go up. The increasing cost of long-term care does not make long-term care insurance premiums go up. Okay, so based upon the case study and based upon the rate increase regulations that are in effect for people who buy newer long-term care insurance policies, Am I suggesting that everyone should buy a traditional long-term care insurance policy? No, absolutely not. I'm not suggesting that at all. In many cases, the traditional policy can be a much better value than a hybrid, but there are many situations where a hybrid makes a lot more sense. So let's take a look at that now. And so who should buy hybrids? Who should buy LTC hybrids? Well, the first one's kind of obvious, okay? Somebody who can't qualify for a traditional long-term care insurance policy, all right? If you can't qualify for that, for a traditional policy, well, yeah, let's take a look at a hybrid. But here's what I want you to understand. The hybrids, they have more lenient underwriting. It's a lot easier to qualify for a hybrid than it is to qualify for a traditional policy. But here's the reason why. Essentially, when you're buying a single premium hybrid, okay, you are essentially pre-funding the first 2 or 3 years of care. In other words, that large lump sum single premium that you pay to the insurance company for the hybrid, well, that policy, that single premium, that large single premium that you pay them is what they're going to use to pay for the first 2 years of your care, maybe the first 3 years of your care. So the insurance company is not incurring any risk until you've needed at least 2 or 3 years of care. So look at it from their perspective. They're using your money, your single premium, to pay for the first 2 or 3 years of care. They don't start to use their money until after that. So because they don't incur any risk until at least the second or third year of your care, then they're going to be a lot more lenient. They're going to accept a lot of applicants for the hybrid who a traditional long-term care insurance company could not accept. All right, so that's one of the beauties of hybrids, is that you can qualify for them even if you can't qualify for a traditional long-term care policy. Secondly, what about couples? If you're a couple and one spouse or one partner can't qualify for a traditional long-term care policy, but the other one can qualify for traditional, well, it might make sense for both spouses, both partners, to get a joint hybrid. There are hybrids where it's one policy, but it covers both spouses or both partners, and that can be a really good value. Okay, so that's another situation where hybrids make a lot of sense. Third thing, if you're over age 70, a hybrid is probably going to make a lot of sense for you, okay? Because especially if it's an annuity LTC hybrid, okay? The annuity LTC hybrids can make a lot of sense for people who are age 70 and over, just because, again, the underwriting is very lenient, okay? That's number one. And number two, because the traditional premiums are pretty darn high if you're in your 70s, especially if you have health problems, okay? So that's another situation, 70 plus, okay? If you want a policy that has an unlimited benefit period, and what that means is that the policy can never run out of benefits, never run out of long-term care benefits. And I've got lots of clients who do. They want a policy that can never run out of long-term care benefits. They're worried about a catastrophic event where one spouse or the other might need 10, 15, 20 years of care, whatever. No problem. We've got policies like that. And in most cases, a policy like that is going to make, it usually makes more sense to buy a hybrid version with an unlimited benefit period than to buy a traditional policy. But we'll compare both for you and help you pick the right one. If you have a lot of your money, if most of your funds are in a traditional IRA or 401k or 403b, in your situation, it's probably going to make sense to buy a hybrid if you want to use those funds to buy the hybrid. And there's ways to set it up where you can spread the taxes out over a 10 to 20 year period, depending upon how we set up the policy. So it's a good option. If that type of funds are what you want to use to pay for your long-term care coverage or to fund your long-term care coverage, well, then a hybrid is probably going to make the most sense for you. And lastly, sixth reason, if you own a deferred annuity, okay, or if you own cash value life insurance that have appreciated significantly, well, you can turn those taxable gains, you can turn into tax-free long-term care benefits by doing a 1035 exchange. I'll say that again. You can take the taxable gains, you can turn those taxable gains into a tax-free long-term care benefit through a 1035 exchange, and we'll show you how to do that. But not too many people have cash value life insurance with a lot of cash value in it or a lot of appreciation. But if you do, or if you have a deferred annuity that has a lot of appreciation, then yes, it can make a whole lot of sense to use those and turn those taxable gains into tax-free long-term care benefits. Okay, and all right, so those are the people who should, where a LTC hybrid does make a lot of sense or can make a lot of sense. So it's time now for the Q&A. If you've never attended one of my webinars, I prefer that you email your questions to me. Here's the email address. It's scott@ltcshop.com. And the reason for this is because I'm probably not going to get to all your questions. We usually have anywhere from 10 to 20 questions, and I'll probably only have time to answer, maybe 5. Okay, so I want to answer as many as I can, but I know I won't be able to get to all of them. So if I don't answer your question right now live on the webinar, then I will reply back via email within 1 to 2 business days. Okay. Now, if you're thinking about buying a hybrid and you're not sure if it's one of the good hybrids or one of the not so good hybrids, go ahead and email me and tell me more about it. Tell me more about the hybrid, and I'll reply back with my opinions. If you've been given an illustration, then feel free to attach that illustration to the email. I'll review it and let you know if there's a better option out there for you. Okay, so again, just send your questions. We've already gotten a few coming in already, but if you email your questions to scott@ltcshop.com. Okay, here's the first question. It says, when explaining the different scenarios, you said that if Jim and Pam died without needing long-term care, their heirs would get a $200,000 death benefit. I was under the impression that traditional long-term care insurance policies don't have a death benefit. Okay, great question. Well, first let me say there are some traditional long-term care insurance policies that do have a death benefit. Okay, you can add a death benefit onto a traditional long-term care insurance policy, but it can't be more than the total sum of premiums paid. Okay, so the most that the death benefit could be would be the total that you had paid in premiums. Now, in this case, when I was saying that Jim and Pam would have a $200,000 death benefit, what I was referring to was that because they did not pay $200,000 single premium to the insurance company for a hybrid, because they didn't pay that $200,000, they kept that $200,000 and just earned money on that $200,000, and the earnings paid the premium for the traditional long-term care insurance policy, and the $200,000 was still there. Okay, so that if Jim and Pam died without needing long-term care, well, that $200,000 would go to their heirs. So it's not that it would be a death benefit. It wouldn't be a death benefit coming from the insurance company paying to their heirs, but it would be $200,000 that their heirs would get at death because they didn't give the $200,000 to an insurance company to pay the single premiums. They kept that $200,000 themselves and used it to generate enough income to pay their premium every year, but they were able to keep the $200,000 in their accounts. So that's what I meant by that. But thank you for asking that question. That's a great question, and I appreciate the opportunity to clarify that. Okay, let's see. Okay, this is a good one. What do you think of MoneyGuard? Okay, well, MoneyGuard is one of the better hybrids. It's one of the better long-term care hybrids. It's probably one of the most popular in terms of the number of sales every year. So MoneyGuard is one of the more popular policies, and it is one of the better hybrids. Okay. However, it doesn't mean that's the best way to go. All right. If you can qualify for a traditional long-term care insurance policy and you're under the age of 70, you're probably going to be a lot better off getting a traditional long-term care insurance policy. But it's going to depend upon your health history. So anyway, so it's one of the better, if you're going to buy a hybrid, that's one of the better hybrids to buy. But depending upon your situation, you might be a whole lot better off, like Jim and Pam were, just by buying a traditional policy than instead of paying a huge lump sum to the insurance company for a hybrid. Okay, and next one says, I have heart disease. Can I qualify for a traditional long-term care insurance policy? And the answer is possibly. Okay, it depends. All right, there's, when you think about it, in some respects, traditional long-term care insurance policies can be a little easier to qualify for in some cases than a hybrid. And here's why. Okay, if you've got heart disease and you buy a hybrid which has a death benefit, well, if the heart disease is something that would cause you to die suddenly, well, then that means the life insurance policy is going to pay out. Okay, it might pay out. So you're a higher risk for that death benefit being paid out. So the hybrid, in some cases, hybrids, won't insure a health condition that a traditional long-term care policy would insure. Because if you think about it, traditional long-term care insurers don't care if you die. Okay, if you buy a traditional long-term care insurance policy, the insurance company is happy if you die, because if you die, then they don't have to pay for any long-term care. All right, so there are certain health conditions which are actually easier to qualify for a traditional long-term care insurance policy than a hybrid. Depending upon the type of heart disease, that could be one of them. All right, so that's a good question. Okay, let's see. Next question says, a retirement planner showed me a hybrid that costs just a little bit more than a traditional long-term care insurance policy. So I'm leaning towards buying the hybrid because it has guaranteed premiums and a death benefit. Okay, that's an interesting question. And I'm just going to tell you that that's not very likely. Okay. I'll give you a story. I'll give you a real story. I was debating with someone, an insurance agent, on an insurance agent forum, and he was telling everybody, he was actually boasting about how he was able to, how this couple came to him and said that they wanted to buy long-term care insurance. And he said, well, don't buy long-term care insurance. You can buy life insurance instead, but we'll set it up so that the death benefit can be used to pay for your long-term care. So he showed them a $1 million worth of life insurance for each of them. Okay. And then he showed them a traditional long-term care insurance policy, and the traditional long-term care insurance policy was very similar in premium. I mean, the life insurance was just a little bit more premium. And I replied back on the forum. I said, there's absolutely no way that the life insurance premium was just a little bit more than the long-term care insurance premium. I said, no, there's no way. And I said, what did you quote them? What kind of benefits did you quote them on the traditional long-term care insurance policy? Well, this is what he did. He'd quoted them $1 million each for the life insurance policy. So they would either have $1 million of life insurance or the $1 million could be used for long-term care. With the traditional policy, okay, he actually quoted them shared benefits. So it'd actually be about $2 million worth of shared benefits, okay? And he included an inflation protection. So within 30 years, they would have gone from $2 million worth of shared benefits to $8 million worth of shared benefits. So he was comparing a traditional long-term care insurance policy with $8 million worth of which would grow to $8 million worth of shared benefits, to 2 life insurance policies that had $1 million each, and that would not grow at all. And unfortunately, he was making a big deal of it, boasting how he got them to buy the life insurance policy. And I don't have to tell you this, but the life insurance commission was a whole lot bigger than the traditional long-term care insurance commission would have been. A whole lot bigger. So anyway, I'm going to say there's no way that the retirement planner is comparing apples to apples for you. And not only that, but yeah, I mean, it just doesn't make sense. There's no way. Or he found an incredibly overpriced long-term care insurance policy, and that's what he's showing you to try to make you buy the hybrid. So anyway, yep. Okay. And let's see. Another health one. I'm overweight. Can I qualify for long-term care insurance? Yeah. Okay. You can. The height and weight charts are actually pretty liberal with long-term care insurance, as long as you're not obese. Okay. But if you're overweight, that's fine. That's not going to prevent you from qualifying for long-term care. And let's see, any other ones? All right, these, let's see. We have time. Yeah, okay, one more. It says, my father's premium just had a big increase a month after we filed a claim on his policy. Is that fair? Well, it's not fair, and I'm not laughing about the rate increase. I'm just laughing that it's a good time, because if he's filing a claim for his policy, then the premium is going to stop. Okay. 99 out of 100 policies out there, when you go on claim and you begin to receive benefits from the policy, your premium stops. Okay. So it's good timing that he needs care right now, because he's not going to be hit with that big increase. He's going to be able to avoid that big increase, because the premium will stop once he begins to receive benefits from his policy. So, okay. All right, we're out of time. There's several other questions that are here. I will answer them within the next 1 to 2 business days. So be looking in your inbox for those answers. Thank you very much for attending today. Please share this, and first of all, give us a good rating, and share it with your friends so that they can sign up for the next webinar as well. All right, thanks a lot. Bye-bye.